Today is Wednesday, February 25th, 2026, and I need to open with a concept that professional traders use with extreme caution, because once it applies to a market, it cannot be reversed by wishful thinking, by central bank statements, or by a single Friday settlement. The concept is a black swan. Nassim Taleb defined it with surgical precision. A black swan is not simply a rare event that catches people off guard. It carries three very specific properties that separate it from ordinary market shocks. First, it is statistically improbable based on all prior recorded history. Second, it delivers consequences of extreme and disproportionate magnitude when it finally arrives. And third, and this is the property that matters most, it is almost never identified while it is happening. It is only recognized in hindsight after the position has already been taken, after the trade has already been placed, after the loss has already been locked in. I'm going to argue today, using nothing but verified public data sourced directly from CME Group's own published records, that the silver market is currently operating inside a black swan event. Not a rumored one, not a speculative one, a documented, numerically confirmed, structurally verifiable one. And I want to be precise about what kind of black swan this is, because this matters enormously for how you interpret everything that follows. This is not a single-day explosion. This is not a Friday default scenario where silver futures suddenly gap up $100 and the headlines catch fire. What we are witnessing is a slow structural migration of enormous accumulated pressure through a physical delivery system that simply does not have the capacity to absorb it. The fuse is not burning toward some future date. It has already been lit. The pressure is already in motion. And the direction that pressure is moving toward is a vault that is shrinking, a supply chain that is operating below normal capacity, and a May delivery window that currently holds more outstanding paper claims against it than the March contract held when this entire squeeze first began. Here's the evidence. And every number I give you comes directly from CME Group's own volume and open interest pages, the CME Depository Statistics Vault Report, and independently confirmed market data. Everything is publicly available and linked in the description. In 6 trading days, Wednesday, February 18th through Tuesday, February 24th, the price of silver moved from $77.18 to $90.35. That is an increase of $13.17 in less than 2 weeks. That is a 17% move. During that same period, gold was up approximately 0.79%. Silver outperformed gold by a factor of nearly 20 to 1. As of this morning, Wednesday, February 25th, silver is trading at 90 to 40 bid. That is a gain of 3.89% on the day alone. Gold is up 0.79% on the same session. Silver is outperforming gold by nearly 5 to 1 on today's session alone. 2 consecutive days of accelerating silver gains while gold moves at a fraction of the pace. This is not coincidence. This is not speculative retail buying. This is not a social media momentum trade. What you're looking at is a documented, price-driven physical squeeze, measurable, verifiable, and happening in real time in front of us. But here is the question that almost nobody covering this market is asking correctly. When a squeeze happens inside a futures market and the contracts are rolled forward rather than physically settled, when longs take profits and shorts cover rather than standing for delivery, where exactly does the underlying pressure go? It does not disappear. It does not evaporate into the settlement ledger. It migrates. It moves forward in time. And what it migrates into is a delivery structure that faces a smaller vault, a slower supply pipeline, and a demand base that does not operate on paper contract calendars. The pressure that compressed March did not leave the silver market. When March open interest started falling, it changed its delivery date. It became May. If you're holding PSLV, if you're watching silver from the sidelines trying to understand what the price action is telling you beneath the surface numbers, or if you simply want to understand why this week's move is not the story, but rather the opening chapter of a much larger structural event, you need to understand what the data actually shows, not the headline price, the architecture underneath it. This channel has been tracking 2 specific structural mechanisms converging simultaneously on this delivery cycle. The first is the COMEX March silver contract first notice day, which falls on Friday, February 27th, the hard contractual deadline for physical delivery declarations. The second is the registered inventory level at COMEX, which has been approaching a floor that would create serious delivery strain if large institutional holders chose to maintain rather than roll their March positions. 4 days ago, a forward framework was published on this channel identifying exactly 2 signals to watch. First, whether Shanghai's exchanges would reopen after 10 days of Lunar New Year closure with Chinese institutions returning as buyers or sellers. Second, whether the March open interest trajectory would confirm the delivery pressure pattern that had already become visible in the February contract data. Both signals have now confirmed. The sequence is documented from verified public sources, and what it reveals is not a market that is calming down after a squeeze. It is a market that is reloading for a delivery window that begins with structurally worse arithmetic than March ever had. On Tuesday, February 24th, Shanghai reopened for its first post-holiday trading session after 10 consecutive days of Lunar New Year closure. The result was immediate and unambiguous. Silver pushed to $87.82 intraday, up 1.44% on the day, while gold declined and the dollar held flat. Chinese institutions returned as buyers. That was the first confirmation. This morning, Wednesday, February 25th, Shanghai is now in its second consecutive post-holiday session. Silver is currently sitting at 90-40, up 3.89% on the day. Gold is up 0.79%. 2 consecutive sessions of Chinese institutional buying at accelerating price gains. That is not a one-day reaction. That is not holiday volatility normalizing. That is a documented, confirmed, sequential demand trend entering a market that was already structurally strained before a single Chinese buyer placed a single order. But the more important story, the story that tells you what happens after Friday, is what the March open interest data showed on that same CME volume and open interest page over those same 6 trading days. And this is where the picture becomes both more reassuring about Friday and significantly more concerning about the months ahead, because the data tells a complete story that most channels covering silver this week have not read fully. Let me show you the full 6-day picture sourced directly from CME's own published records. On Wednesday, February 18th, March silver open interest stood at 455,000 ounces. On Thursday, February 19th, it fell to 239,235 ounces. On Friday, February 20th, it declined further to 222,710 ounces. On Monday, February 23rd, it dropped to 255,000 ounces. On Tuesday, February 24th, it fell again to 140,030 ounces. That is a reduction of 153,625,000 ounces of March open interest across 6 trading days. An average roll rate of approximately 25.6 million ounces per day exiting the March contract. The March squeeze is being diffused through price. Longs entered near $72 and are taking their profits at $90. Shorts who held below that level are covering before the delivery window forces their hand. Both sides are exiting March simultaneously. And as a direct result of that bilateral exit, the March contract, which as of Tuesday night holds 114,830 ounces of open interest against 87 million ounces of registered vault silver, IS on a trajectory that should bring it to or below the vault floor by Thursday's close. Friday's first notice day will most likely produce an orderly settlement. If that is the complete picture, the story ends here. March resolves. Silver pulls back slightly. Everyone exhales. But the complete picture requires one more column from the same CME data. Because every single contract that left March went somewhere. And where it went is the second half of this story. And the half that changes everything about how you should be reading this market going forward. The CME volume and open interest page does not just show March open interest. It shows the full breakdown across all active contract months simultaneously. And the May column tells you everything you need to know about what happens after Friday. On Wednesday, February 18th, the same day March held 268 million ounces. May open interest stood at 229,110 ounces. Now watch what happens to May over those exact same 6 trading days that March was collapsing. Thursday, February 19th. May open interest rose to 255,450 ounces. Friday, February 20th, 280,735 ounces. Monday, February 23rd, 324,150 ounces. Tuesday, February 24th, 350,260 ounces. May open interest grew by 120,150 ounces across the same 6 trading days that March shed 153 million ounces. The mathematics confirm exactly what the data shows. The overwhelming majority of contracts exiting March became entries into May. The pressure did not leave the market. It changed its delivery date. This is the mechanism that most coverage of this week's silver move has missed entirely. The channels that were projecting a Friday default looked at March open interest falling and called it a diffusing of the squeeze. The channels that were dismissing the squeeze completely looked at March open interest falling and called it proof that nothing was happening. Both readings are incomplete. Both readings are wrong. The correct reading is this. The March squeeze compressed so effectively through 17% price action in 6 days that longs took profits and shorts covered. But the institutional holders who entered this market believing in the physical tightness thesis, the vault drain, the Eastern demand, the supply disruption, did not exit. They rolled. They made a deliberate decision that the structural conditions driving this squeeze will not resolve between now and May's delivery window. They are now positioning 350 million ounces of open interest above a vault that today holds 87 million registered ounces. Now ask the question that follows directly from that arithmetic. What does the registered vault look like when May's first notice day arrives in late April? To answer that, you need to understand something that has received almost no coverage on silver channels this week. Something that is happening right now inside Mexico that has fundamentally altered the supply equation for COMEX registered silver going forward. For the vault drain to reverse, for those 87 million registered ounces to grow back toward levels that could comfortably absorb May delivery demand, new silver needs to flow into COMEX-approved warehouses. That means refined silver bars meeting COMEX specifications, moving from mines and refineries through logistics networks and into the approved depository facilities located across the United States. The primary source of that refined silver has historically been Mexico. Mexico is the world's largest silver-producing country by volume. Its mines and smelting facilities feed the global supply chain. Under normal operating conditions, refined silver bars move from Mexican smelting facilities through overland logistics networks to COMEX-approved warehouses, continuously replenishing the registered inventory that physical deliveries drain. That flow has now been severely disrupted. The transportation infrastructure for silver bars moving through Mexico has been severely compromised by escalating cartel activity along the primary overland routes. The threat of theft during overland transport has made the direct shipment of refined silver bars, which are dense, valuable, and visually identifiable, through Mexican logistics networks effectively non-viable under current security conditions. In response to this deteriorating security environment, some silver mining and smelting operations have shifted their logistics strategy entirely. Rather than shipping finished refined bars through the compromised domestic transport network, they are now transporting raw ore and concentrate to refining facilities located outside Mexico, processing the material there, and then routing the finished product into the global supply chain from those external locations. The refined bars are still eventually reaching their destinations, but the pipeline is now longer, slower, and operating at significantly below its normal throughput capacity. And the consequence of that, reduced throughput for COMEX registered inventory, is direct, quantifiable, and already visible in the vault data. In the period from February 18th through February 23rd, the only dates with fully confirmed vault reporting at the time of this recording, registered silver held flat and then declined. Not a single ounce entered the registered category to offset the ongoing physical drain. The eligible category, which represents silver stored in COMEX facilities but not yet warranted for physical delivery, has also been declining steadily. The vault is losing metal from both categories simultaneously with no documented inflow arriving to offset it. This is the supply pipe. It is not closed permanently. The situation in Mexico will evolve. Alternate supply routes exist and are being developed. But right now, as of the date of this recording, the vault that will face May's 350 million ounces of open interest is running a net deficit with no visible replenishment arriving. And it is doing so from a base of just 87 million registered ounces, the lowest registered inventory level in years, after losing 47% of its starting base in under 5 months. Let that number settle for a moment. In October of 2025, COMEX registered silver, the only category of inventory that can legally be delivered against a futures contract, stood at 167.7 million ounces. As of Tuesday night's confirmed vault report, registered silver stands at 87.17 million ounces. That is a reduction of 80.5 million ounces in less than 5 months. Those are not accounting reclassifications. Those are not paper adjustments. Those are physical deliveries. Bars left the vaults. They moved to industrial users, to sovereign buyers, to investors who demanded the physical metal. And they did not come back. The vault cannot grow back fast enough to change the May arithmetic unless the Mexico situation resolves completely and silver begins flowing back into COMEX warehouses at significantly above normal rates. That has not happened yet. There is no data suggesting it is imminent. Now add the second demand pressure that has been confirmed over the past 2 trading days, because the supply problem is not just about what is failing to come in from the West. It is also about what is being actively pulled out from the other side of the world. The Shanghai Gold Exchange and the Shanghai Futures Exchange both closed on February 14th for the Lunar New Year holiday. 10 consecutive trading days of complete silence from the world's second largest silver futures market. 10 days during which Chinese industrial buyers, solar panel manufacturers, electronics producers, and institutional hedgers had zero access to their primary domestic silver exchange. The demand did not evaporate during those 10 days. It queued behind a closed door. Before that door closed, the Shanghai Futures Exchange silver inventories had already fallen to approximately 353 metric tons, a 10-year low. Despite those critically low inventory levels, the SHFE silver price was trading in backwardation before the holiday began. That means the exchange was already pricing immediate physical delivery above the deferred forward price. Chinese buyers were already paying a premium to secure metal today, rather than wait for future delivery. Physical scarcity was being priced directly into the structure of China's own futures market before the country went silent for 10 days. When the door reopened on Tuesday morning, the accumulated pent-up demand released directly into the global spot price. Silver pushed to 87 or 82. Gold fell. The dollar held flat. Silver moved completely alone. That is the footprint of physical demand, not speculative paper buying. When silver moves, while gold falls and the dollar holds steady, there is only one explanation. Someone needs the physical metal, and they are paying whatever price the market requires to get it. Today is Wednesday, Shanghai's second consecutive post-holiday session. Silver is up 3.89%. Gold is up 0.79%. Silver is outperforming gold by a factor of nearly 5 to 1 for the second day running. 2 consecutive sessions of sustained Chinese institutional buying into a market where SHFE inventories were already at decade-low levels before the holiday even began. The significance of this for the May setup is direct and unambiguous. Chinese industrial demand for physical silver does not operate on COMEX's contract calendar. Solar manufacturers do not pause their procurement schedules because March 1st notice day falls on a Friday. Electronics producers do not halt their supply chain because a futures contract is rolling from one month to the next. The demand that Shanghai's reopening is confirming is structural industrial consumption. Solar panels, photovoltaic cells, or electronics components that requires physical silver to be sourced continuously regardless of what the paper futures calendar says. That demand is now pressing simultaneously against SHFE inventories at 10-year lows, against COMEX registered inventory at 5-month lows, and against a Mexican supply route that is currently operating below capacity. The squeeze in March was driven by paper positioning and price action. The setup building for May is being driven by something that does not roll forward on a futures calendar. Physical demand does not roll. It does not negotiate with first notice day. It simply consumes the available metal. And the available metal is running critically low on both sides of the planet at the same time. Let me now show you the forward-looking arithmetic. Not for Friday. Friday is largely resolved through the roll data we have already examined. The number that matters, the number that 350 million ounces of May open interest will eventually have to reconcile with, is the vault number that will exist when May's first notice day arrives in late April. On Tuesday, February 24th, May open interest stood at 160,000 ounces. That figure will grow further as March rolls continue through Thursday. Every contract that has not yet exited March is on a clock. The ones that do not settle physically before Friday's first notice day will either stand for delivery or roll forward. Based on the trajectory we have documented over 6 trading days, the overwhelming majority will roll, and the overwhelming majority of those rolls are going into May. So the question is not whether May will face delivery pressure. The question is whether the vault that faces that delivery pressure will have enough registered silver to absorb it without triggering the kind of structural emergency that COMEX Rule 589 was specifically written to address. May's first notice day arrives in late April. Between now and then, the registered vault must either hold at 87 million ounces or grow. And to grow, it needs silver flowing back in through a supply chain that is currently disrupted at its primary source. The ratio of May paper claims to current registered inventory is already 4 to 1. 4 ounces of paper obligations for every single ounce of registered physical silver available for delivery. That ratio will worsen if the vault continues its documented drain rate of approximately 785,000 ounces per day, while May open interest continues building. If May open interest holds anywhere near its current level and the vault continues losing metal without meaningful inflows, the arithmetic for May's delivery window will be structurally more constrained than anything the March contract produced. And unlike March, there will be no 10-day Chinese holiday to suppress demand in the interim. Shanghai will be fully open. Industrial buyers will be fully active. The pent-up demand effect that amplified Tuesday and Wednesday's price action will not be a factor because there will be no closure period to create it. The demand will simply be continuous, structural, and pressing against whatever registered inventory the vault holds at that point. This is where COMEX Rule 589 becomes relevant, not as a Friday emergency mechanism, not as a doomsday scenario for this week's settlement, but as the exchange's own documented contingency protocol for exactly the kind of scenario that is now building across a longer structural timeline. Rule 589 grants COMEX the authority, under emergency conditions, to force cash settlement rather than physical delivery on outstanding contracts. It exists precisely because the exchange itself acknowledges that a scenario where paper obligations significantly exceed deliverable physical supply is a structural risk that requires a predetermined response framework. The existence of Rule 589 does not mean it will be invoked for May. It means the exchange has already wargamed this scenario and written the protocol for it. The question of whether it gets invoked depends entirely on 2 variables. First, whether the vault drain reverses meaningfully before late April. Second, whether May open interest rolls down significantly as first notice day approaches, the same way March rolled down over these past 6 trading days. Both of those outcomes are possible. Neither of them is currently supported by the data we have in front of us today. The vault drain has shown no signs of reversing. Not a single documented inflow arrived in the registered category during the confirmed reporting window from February 18th through February 23rd. The Mexico supply disruption has not resolved. The eligible category is declining alongside registered. In May, open interest just grew by 121 million ounces in 6 days while March was collapsing. The institutional money that rolled from March to May did not roll because they believe the structural tightness thesis has been disproven. They rolled because they believe it has not yet fully expressed itself. Now step back and look at the complete picture that the data builds when you read all three layers simultaneously. Layer 1, COMEX registered vault silver has lost 47% of its base in 5 months, currently sitting at 87 million ounces with no documented replenishment arriving. Layer 2, May open interest stands at 350 million ounces and growing, representing a 4-to-1 paper to physical ratio against current registered inventory. Layer 3, Chinese industrial demand has confirmed 2 consecutive sessions of accelerating buying into SHFE inventories at decade lows, with no holiday suppression period ahead to interrupt that demand between now and May's delivery window. 3 independent data streams, 3 separate verified public sources, all 3 pointing in the same structural direction simultaneously. This is what a slow black swan looks like from inside it. It does not announce itself with a single dramatic Friday headline. It builds through data points that individually seem manageable but collectively describe a system under pressure that is migrating toward a delivery constraint that the current physical infrastructure is not positioned to absorb comfortably. Silver at $90.40 this morning is not the ceiling of the story. It is the market beginning to price the arithmetic that the open interest data, the vault data, and the Chinese demand data have been describing for weeks. The price on your screen is not leading the fundamentals. It is catching up to them. And the fundamentals, as of Wednesday, February 25th, 2026, measured entirely in verified public numbers from CME's own records, describe a May delivery window facing 350 million ounces of paper obligations above an 87 million ounce vault supplied by a pipeline running below capacity, with continuous structural industrial demand pressing from the eastern side of the global market with no interruption, scheduled between now and late April. The fuse was lit before most people noticed the smoke. The pressure is already moving, and the vault it is moving toward is smaller today than it was yesterday.